Welcome back, guys. In today's video we're going to talk about Dollar General, or ticker symbol DG, and why I think it is a strong buy. We're going to go over the fundamentals. I'm going to go over some of the prices from the last couple of years. We're going to go over recent news and information, and also what's been going on with this pandemic overall. As you can see, in the last year they have not suffered at all on their stock price and appreciation. They also pay a dividend yield, and we're going to get into that in all this video. So stay tuned. So Dollar General right now is at $211.34. It's up 35% since last year, which is a 55% appreciation on the stock price. In March, it was at 166, and it looked like during the pandemic it went down to 137. So that's a pretty big dip for them, but I've seen a lot worse with other companies. Now, Dollar General is definitely an essential company, so it stayed open during this virus that we had at the beginning of the year, and it's done nothing but increase on its revenue and its profits all year. As you can see, it's up almost 200% in 5 years, which means you could have bought this company for $71 in January 2016. This is a 70% buy rating from analysts. And for all of you who know, of course, Dollar General is just one of those stores that has it all. You know what I mean? It's probably at your town or city you live in right now currently, but they pretty much sell anything from makeup to food to basic cleaning supplies to houseware stuff, even cigarettes and things like that. So I'm pretty sure everyone knows what Dollar General is. So moving on, the CEO is Todd J. Vassos. They employ 143,000 employees, founded in 1939, and they're headquartered in Godlettsville, Tennessee. They have a market cap of 51 billion, a PE ratio of 20, almost 21, and a dividend yield of 0.66, which isn't a very high dividend yield, but this is also a safe company to get into. Average volume right now is 2 million. Again, with the analyst rating, it's saying a buy of 70%, a hold of 26%, and this is coming from 27 ratings. So this is one of those companies that have a lot of viewers and a lot of ratings on this company. Sell off would be 4% rating for selling. If you guys want to pause the video, you can read over what the bulls have to say about why this company is doing so great, and you could also read about what the bears are saying, why the company could suffer long term. These both articles were published by Morningstar December 13th. But for now, if you guys want to just listen to what I got to say, then let's just continue on. Their earnings per share right now looks like it's hovering just above $2 per share. So for every share, it makes $2 in profit, which is just amazing. I never invest in companies that have a negative earnings per share or a PE ratio above 50. So it's sitting right at 21 on the PE ratio. Some dividends that came back to me, I got 36 cents in July on the 21st, and I reinvested it into the company itself. Looks like I sold a majority of my shares on July 29th to get out of the company, but I will be buying in now that there has been a lot of movement and traction here, which is pretty awesome. If you want to look at the 3-month chart, it's only up about $1.84. 1-month chart looks like it's down about 2%, and the 1-week chart looks like it's down almost, it's a 0.5% point, not much. let's go and move on to the street rating report. They're giving this company A for their buy rating, and as you can see, their target price is at $277.16. So this company does have a lot of opportunity to grow. Again, annual dividend rate at $1.44 or 0.68%. And long term, it looks like this company is doing very well. I mean, it hasn't really stopped at all. The growth per share is just amazing. Their bottom line earnings is much higher at $6.65 compared to the prior year at $5.98. What else? Their net income increased by 57% from the same quarter 1 year prior, which means from $365 million in net income to $574 million in net income, which is just amazing, guys. This company is just tremendously growing and outperforming. It's favorable among its competitors, as you can see here, and they are just making a ton of money right now, which is just amazing. Moving on, their factors for this rating of A would be 5 out of 5 stars for growth, 4.5 out of 5 stars for total return, 5 out of 5 for efficiency, 5 out of 5 for price volatility, 3 out of 5 for solvency, and 3.5 stars out of 5 for income, which is amazing. I just love companies that can perform and just have incredible gross profit margins and just great PE ratios, dividend yields, earnings per shares, all that incorporated into a company like this who has outperformed the stock market over the last 5 years and probably longer, which leads me to my next page, which is Yahoo Finance. Here's some more accurate statistics. Robinhood does a great job, but sometimes they're not as accurate. PE ratio again right there at 21. Earnings per share looks like at $10.10. Not bad. And their expected forward dividend and yield is $1.44 or 0.68%. Not too bad. Now let's look at the max chart here. As you can see, it's been growing since it established in 2009 from $23, guys. That's amazing percent gains. I mean, that's like 1,000%, and it goes all the way up. Slight dips every once in a while, but nothing major. Like whereas my last video with Carnival Cruise Line, you see it go up, 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 and then it has a huge, tremendous dip because of something that happened in the world, and then it goes up, 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 and that's happened for quite some time. As far as related articles and news, I didn't really see too much going on. I mean, that's pretty much relevant to this video and why I think Dollar General is such a great stock. I mean, they did a fantastic job. Same store sales has risen around 14%, even amid the pandemic. So that's really freaking cool. And there's not much to say about that other than they are a great company. Moving on to dividends. Ex-dividend date for all that you guys that watch this for dividends, it's on January 4th. So if you want to get in on a 36 cents payout per share, then you need to own this company pretty much this week. You have to get it before the 4th, which is Monday. So I would say by Thursday or Friday, you should definitely buy this company to get in on this. As you can see, they have been increasing their dividend yield for quite some time, and they started paying out in 2015. So this by no means is a dividend aristocrat, but as you can see, over the last 6 years, they have been consistent on their payments, and these are quarterly payments, which is pretty great. It's not monthly, but that's okay. Quarterly does just fine. So if you guys have any questions, or you guys like the video, or even want me to do another video on a different company, then please go ahead and comment that below, and don't forget to smash that like button. You guys have a great day.